So, why does your tax bill double as your business is growing? You might be making a lot more revenue now. You brought on a ton of clients. The team is expanding, but the tax bill is expanding as well. And it's almost compounding faster than all of those combined. And there's a reason why this is happening. And also, there's a way how you can stop this. So, in this video, I'm going to be covering two reasons why this is happening, why service businesses are always going to get hit harder in this case, and how to fix this problem as you're growing revenue. So your next revenue milestone isn't also accompanied by a massive tax bill. And if you also want free access to my tax bill estimator so that you can follow along in this video and make this all a little more custom to your situation, there's going to be a link in the description that you can download that. Now, there's two reasons that this happens. And first, there's an assumption that a lot of people make that's incorrect. They think that as their income goes up, the tax bill is going to go up by the same amount. And that's just not how this works. So there's two problems that are going to hit you at the same time, and most founders are only thinking about one of them. So first is the federal tax brackets. Remember, the US tax system is progressive. So every extra dollar is going to get taxed at a higher rate. So when you jump from say 200,000 to 400,000 in profit, and that top 200,000 is going to be taxed at a significantly higher rate than the first 200,000. You could see it, where you go from an effective tax rate of 22% to 32% on that top portion. So it's not just growing a little bit. The tax bill is jumping massively in that case on the federal side. Now, on the state side, most people completely forget about this part. They pay it, but it's not top of mind for them. This can alone add another 5 to 13% on top of the federal tax bracket, depending on which state you're in. And just like federal, many states have that progressive bracket. So the more money you make, the more you're taxed. And the worst offenders of this I've found to be are California, New York, and New Jersey. I actually had a client recently that I was just helping out. He lives in the state of California. He made $150,000 in profit last year. He's going to owe $50,000 on his tax bill. It's a 33% effective rate, which is really high on that amount of income. So if you're in one of those states, please be mindful of the state income taxes. And when you stack that federal and state together, you're suddenly paying 40% or more on all of those top dollars that you're making. So I want to make this a little more real with an example with numbers. So let's say you netted 180 grand last year and you paid a tax bill of about 45,000. Now let's say this year you made 380,000, so 200,000 more, but now your tax bill could be 130,000 or more, a really big jump there. It's not 30% more, that's almost triple the amount versus last year, a really big jump. And on that $200,000 of additional profit, a huge chunk of that is just going straight to federal and state taxes before you even see it. So it's a really big problem. And this is why as you start to make more and more profit, you need to find ways to lower it. Otherwise, you're going to be paying way more tax over time. And there's a reason why service businesses are always going to get hit a little harder when it comes to their tax bill just skyrocketing through the moon. And product businesses don't deal with this a lot because they have a built-in tax strategy. So think about what they sell. They sell products, and they need to buy physical inventory to create the products. They might need to spend a lot of money on raw materials and production in order to get the product shipped. All of those are instances where they can use that money to offset their taxable income. They can also invest in physical assets. Some service businesses can do this as well, but usually product businesses do it much more, where they're buying equipment, they're investing into buildings just to stay in business or maybe even expand. And what's nice about those for them is they can depreciate those, meaning an ongoing write-off and deduction against their taxable income year over year. So they get that as a nice break. But most service businesses don't have that because your assets are people and time, and those do not cost as much money as producing goods. So almost all of the profit that you're making is fully taxable and you have no natural shelter. So the same profit that a product business might make, you might make the same, but you will be hit with a bigger tax bill every time. And that's going to be a problem. And then the other thing that you get hit harder with is timing. So with a service business, because you don't have those natural built-in tax strategies, you need to manage your cash flow better. And here's an example of mismanaging it wrongly. So you might think that your tax bill is 50 grand at the end of the year. So everything else that you have outside of that savings, you might reinvest it into the business. You might pay yourself to go on a vacation or buy yourself something nice. But then at the end of the year, let's say your CPA comes to you and your tax bill is actually $100,000. Now you're $50,000 short of that bill. You already spent all that extra money and there's a gap between what you've saved and what you owe of 50,000. So you get hit even harder and it feels like the tax bill is just becoming something that you can't manage as you start scaling. So these are the problems that happen. But how do you fix this going forward? How do we make sure that as revenue scales, the tax bill is not scaling too much as well? What I would do is add two financial systems to your business. The first is getting quarterly tax projections. If your CPA is not sending you a projection for what you're going to pay for April, June, or October for the following quarters, you're being handicapped, especially if you're in a fast scaling business with revenue coming in, team members being hired, and things are changing quickly. And the reason why you need this is because this is going to show you what you'll owe so that you still have time to act on it. And now, once you know what you owe, you can implement strategies that are going to drive down that projected number. This is the number one way that you're not going to have the tax bill doubling and doubling over time. You need to lower the taxable income. And there's ways you can do it, but only if you know it ahead of time. That's the key to the game. You can ask your CPA for this specifically. If they don't offer it, that's troubling, and I would consider looking elsewhere, especially again, if you're fast scaling. The second system that I would build is a monthly tax reserve system. So every month, I would move a set percentage of profit to a separate account. I think 30% is a good start, and it's just going to prevent any cash flow problems when tax payment time comes. Now, I bet a lot of you are probably already doing that. So the bonus for you, if you are, is that if you dial in that first financial system, and you get really good at projecting your tax payments and you know what they're going to be, you can optimize that percentage number that you're saving in the tax bucket. Let's say it's 30% right now that you save, but maybe if you get better at projecting it, you only have to save 20%. That extra 10%, now you can freely spend that on growth to make more money in the business so that it's not tied up and you're over saving over time. So not only is this a way to save money and prevent a lot of chaos, it can also make you money in this example. So these are the two financial systems that I would have set up so that the tax bill is not doubling over time as your revenue keeps scaling. And if you want a custom breakdown of why your tax bill is so high, again, we went over some examples in this, but it's always a lot easier if you know your own numbers and you can see your situation. You can download my tax bill estimator. The link is going to be in the description. All you're going to do with that is answer 5 to 7 simple questions. They're not very difficult. You don't need to be super financially minded to answer them. And it's going to show you your estimated tax bill, effective tax rates, how much you should put towards quarterly reserve amounts, and any planning opportunities or warning flags that you should be mindful of in the current year. It's going to take you about 2 minutes to complete this, and it's just going to give you a ton of clarity for the year so that you know what to do going forward. If you want that, the link is in the description to download. I also have a ton of other videos just like this one on my channel going over tax and financial strategies so you can build a more tax efficient cash flowing business. If that interests you, check out my channel and you can look through all the videos. And I hope to see you in the next one.